So what are the 5 biggest issues the IRS is currently looking at during every audit? The first is income. IRS always wants to determine whether people have accurately reported the correct amount of income. And the way you can verify that before you file your tax return is to contact IRS and ask for a wage and income transcript. This is a transcript IRS compiles based upon all the income reported under your Social Security number by third parties. This could include your employer, this could include any investment accounts you have, any bank information where the bank has paid you interest, 1099s from other independent contractor work. Lots of information is reported to IRS. This is a way for you to verify that. Get it before you file your tax return. And if you have a CPA, still check it because you might not have provided all the information to your CPA, and it's important that you get that information accurate. The second issue that IRS always looks at is if you have a business and you report a loss at least 1 year or more, that's a potential trigger for an IRS audit. So if you have a business and you're losing money, right, and IRS is looking at that and going, okay, is this a legitimate business? Why is this company losing money? Now, if it happens more than a year, that's where the risk of an audit definitely increases. And we've had companies that we represented, and for instance, we had a company that had yachts that they leased out with a captain to go fishing in Mexico. Well, the company invested lots of money into those yachts. They obviously took depreciation. There's a lot of factors that went in there, but they lost money. And after the second year of losses, IRS said, hey, hold on a second. We want to make sure this is a legitimate business. Is it a profit motive business? Are you intending to make a profit, or is this really a hobby? So definitely check to make sure if you have losses on your company's corporate income tax return, or if you're a sole proprietor or even a single member LLC, that return gets processed and reported on your 1040 personal return. Take a look at the expenses, look at the income, do a bank deposit analysis like the pros, and that's what we do as well as the IRS. We add up all the deposits every month and subtract out any transfers and non-taxable income, and we'll come out with an amount which should be identical to what's on your tax return. There are going to be some variances, but you have to be able to explain why the income is off if all of it's not being reported. So the wage and income transcript and bank deposit analysis are 2 ways you can verify that before you file your tax return. Now, if it's already too late and you've been identified by the IRS for an audit, definitely get those 2 things as well and understand what the issues are before going into the audit. The third area IRS always focuses on is for people who own real estate. And typically, real estate produces losses. Not always, but it can. And if you own real estate and you're depreciating it, or you get a bonus depreciation, or you did a cost segregation study, and that's producing some large losses, IRS might inquire into that. So make sure you keep really good records as to the income and the losses. Now, if the property is not being rented out, then it's not available for rent. IRS may disallow those losses or at least the expenses, and therefore reducing the losses. So make sure that the property is available for rent. Make sure that, number one, you're also entitled to deduct and offset losses against other income if you're doing that. And 3, if you have any backup support, keep that in a file. Keep accurate records as to all the expenses, the receipts. And if you have a cost seg study, make sure you study that, talk to your CPA or the company that performed the cost seg. Make sure it's accurate and that you keep that report in your file, because a year or 2 after you file a return, likely IRS could come back and you're going to have to pull that report out to be able to justify the numbers. One point I wanted to touch on, I mentioned just a second ago, if you're reporting a loss on real estate and you are reporting it as an active loss, not a passive loss, but active, and you're offsetting other active income, maybe from a business, maybe from your W-2 employment, you're going to need to substantiate that you are a real estate professional or some other exception, because typically real estate is a passive activity. The real estate professional exception requires you to document that you have 750 hours or more in your real estate activities to justify being active, right? Not a passive activity. So if you are a real estate professional, for instance, if you have a broker's license or a salesperson's license, that's not enough. And you don't have to have that as well. But if you are actively dealing in real estate and 750 hours or more for that year, you can document it, and you will need to show how the hours tally up to the 750. Then you may qualify for that exception and therefore get the losses or the losses to offset other income. The fourth area IRS is looking at is cryptocurrency. Now, this has become a big issue in recent years. More specifically, IRS has, if you look at the 2022 return and now even 2021, they have some questions on there. Do you have any cryptocurrency account? That's a pretty important question. If you mark no, there could be some severe consequences to that, depending upon what you're doing in those cryptocurrency accounts. If you're trading, if you're moving money offshore, all these could impact and create significant liability. So also check whether you have a decentralized wallet or centralized wallet. If you have a decentralized wallet and you have to then tally up your transactions, the income and the losses, that's a lot more work for you. Make sure you have that ready to go before you file a return. And if you've already filed a return, go back now and reconcile it, making sure you can substantiate the numbers, because if you get audited, you're going to have to show that to IRS, or that might, increase the amount of tax you're going to have to pay, because it likely will increase the amount of income if you can't show the losses as well as the income that it produces from the cryptocurrency account. And also, where did the money go? What is it being used for? Those are some of the questions that definitely come up. And I can tell you, the moment IRS the auditor asks in a meeting, when you have a meeting with them, the very first question, or not the first question, maybe the 10th question, they're going to ask, do you have a cryptocurrency account? And if you lie to them, obviously that could be a significant problem and could cause other liability, both civil and criminal. But if you're straightforward, he says, yes, I do have a cryptocurrency account, there's going to be a whole host of questions that come from that. They're going to want you to produce the statements. And if you have a decentralized wallet, that's going to get deeper, and there's going to be much deeper analysis. They want to know what you did with the money and whether you made income or lost money on it. So, very important question. And then the last one is for business owners, the ERC credit. The ERC credit is a refundable credit that was available to business owners who were suffering during COVID. Their business was impacted significantly. We're not going to go into the analysis, but there's some definite specific tests that you have to run. And more importantly, if you received an SBA PPP loan, and that loan was used as it should have been to pay for wages, those wages cannot be included in the ERC calculation because you received money from the government. Presumably it was forgiven, and now you're using that same calculation, those same wages that were paid with government money to get a refundable credit. It's double dipping. Make sure the calculations are correct. If you're not sure, talk to the CPA or the company that prepared the amended return and the ERC application. Have them show you how the numbers were calculated and that you separated out wages paid with PPP funds versus wages paid with your own funds, the company's funds. Hope this information was useful. I'm John Milikowsky, founder of Milikowsky Tax Law.